liquidity and financial flexibility, that represents a significant risk, refinancing risk. And what we did incorporate into our rating position before the most recent downgrade was that we expected a progressive build-up in liquidity, and we put some benchmarks out there in terms of balance sheet cash, and we expected to see some progression in the managing down of that refinance concentration in October. Look, for very explainable reasons, probably from a company perspective, some of those targets weren't met compared to what we'd had factored into the rating. Again, this is not something that we prescribed for the rating. It was merely something that we said, well, look, to keep the rating where it was, this is the sort of improvement in the liquidity position that we would need to see. Without those, the rating would come under downward pressure.
Earlier in the year, you reaffirmed that double B,
yes,
and that was the level of rating that they needed to get accepted into the extended Crown Retail Guarantee Scheme. I think it'd probably be fair to say there was a little bit of cynicism in New Zealand at that point that they had been reaffirmed there. Is there any suggestion of any pressure from on high, from the government or anyone, to keep that rating at the level that enabled them to get into the extended scheme?
Absolutely not. In fact, we had them on credit watch negative at that time, so there was a clear signal that there was a reasonable prospect of the rating being lowered. The government's deliberations and decisions about who makes it into the guarantee are theirs, and something we had no contribution to.
Mm-hmm. We've talked about the Crown Guarantee Scheme. Obviously, that's going to be extended from October 12th this year through to the end of 2011. You've touched on the South Canterbury, I guess, wall of money, for want of a better term, that's due for renewal in October this year.
Yes.
How concerned are you about companies facing these massive rollovers as the guarantee comes off?
Yeah, very concerned. It's a good question, and one that we're spending quite a bit of time monitoring. One of the key things to recognise also is that we're seeing a real distortion in the market at the moment with respect to some depositor behaviour and some market dynamics on liquidity. And let me just explain this for a minute. Clearly, at some stage, the finance companies will need to start living in a world without the benefit of the government guarantee. Issuing non-government guaranteed debenture investments at the moment is very difficult because you've got entities such as South Canterbury Finance, who for good reason, are offering rate kickers to attract liquidity that they need to attract to manage their own refinancing risk. Now that's, as I said, it's putting a position in the market where someone that's after a yield investment, they can sort of get guaranteed debt at a higher rate to what anyone else is paying in the market, and so that causes a little bit of a distortion between what might be the risk reward tension that you typically see in a free market. But look, what we're doing at the moment is we're looking closely at reinvestment experience, even with the government guarantee. There will come a time next year, even for those that have been accepted into the extended guarantee, where we're going to need to see evidence of them being able to raise non-guaranteed funding. And absent that ability, downward rating pressure is certainly not off the table. Mm. And we've got a negative bias on the finance company sector, and I think that this sort of liquidity and refinancing risk is certainly one of the key issues driving that.
Yeah, I mean, for the finance companies raising non-guaranteed funds, it's not going to be easy in the new world we live in, is it, post the global financial crisis and post the wholesale meltdown of the finance company sector in New Zealand. Do you think that, given the dozens of finance companies that we've seen collapse in New Zealand in the last 3 or 4 years, that the model has a future?
Look, it's probably not our position to opine about whether the model has a future, but it's fair to say that there are. I mean, we've got ratings out there in the single B and double B minus category in the finance company space, and we're suggesting with those ratings that they have a viable future. If it was a situation where we felt that this sector did not have a viable future, then the ratings would be significantly lower than what you're seeing with some of these companies. And And, secondly, there are some companies out there that have shown some ability to raise unguaranteed debt and some ability to, manage through what has been some system pressures. So, look, I think there'll be further consolidation. I think there'll be changes in perhaps some aspects to the way the sector looks and runs in the future. But, the scenario for this sector to disappear altogether, probably in my mind's a little way off the horizon.
But I guess we saw yesterday with Marek and the two building societies a good example of what we may see more of, and indeed what we may need to see more of for the sector to have a viable future. Yes.
Yeah. Look, I think that one of the things you would think that was very critical to the interest of parties in getting together and merging is to create a larger, more stable entity. That's easily achieved where you can get partners that are compatible and where it makes sense. And so the whole consolidation story is one that is likely to continue. Interestingly, the finance company space is not where we've seen most of the consolidation in the non-bank deposit-taking sector. Most of it's really been about credit in the sort of saving institutions, credit unions, building societies. I know two of these that have sort of histories of building societies histories, but certainly consolidation we think will continue, and certainly the benefits that can be achieved through consolidation will be key in supporting the prospects of more going forward.
Now, onto a broader issue. Obviously, in the wake of the global financial crisis and the subprime problems in the US, the credit rating agencies internationally have copped a lot of flack.
Yes.
How do you feel about, I guess, the role the S&P and the other ratings agencies played in that big global crisis? And do you think that you've rightly had some blame pinned on you, or do you think it's been a bit unfair?
I can only talk about the area that I'm really involved in myself analytically, but Standard & Poor's has been on public record in accepting that we're a market participant, and if you look at the performance of some of the structured products, they didn't perform exactly how we may have anticipated, and it's very fair and true to say that Standard & Poor's has responded with some changes to address those issues. In terms of ratings performance, even on the structured side, the performance of some asset classes have been still pretty strong. So I think you sort of can't throw the baby out with the bathwater in some of this, assessment of some of the issues in hindsight. There are areas that needed, us to adjust to, and we're doing that. But equally, there are other areas that did okay and are doing okay. If we look at the corporate and financial services ratings, the historical default data suggests that the ratings are performing as we would have expected. If we look at the, for example, single B rating category, we're not saying that these companies can't default. Our historical data is saying that 5% of single B category ratings are likely to default within a 12-month period. So, that tells you that there will be further defaults in that particular rating category. What we're trying to do here in financial markets, our role is to really, provide some information to investors for them to use, among other things, to make investment decisions. And our ratings are certainly not, guarantees that things may or may not default. They're merely a tool that help investors, again, among other things, understand our view, our opinion on the relative creditworthiness of one company compared to another.
Okay, thanks for that, Peter. It's Peter Sikora, the Director of Financial Institution Ratings from Standard & Poor's in Australia and New Zealand, and this is Gareth Vaughan from interest.co.nz, and goodbye for now.
Thank you.